a couple of minutes for everyone to settle in. Okay, I think yeah, we still have people still joining in. Just one more minute, and then we can actually kick off the webinar. Okay, greeting to all guests. Thanks once again for attending this. My name is Edward from the intermediary sales team. And today I will be moderator for this event. Before we start the webinar actual, can I request, kindly request everyone to actually just type in your questions if you have any in the Q&A chat box. It will definitely be good to see questions coming in. So I think today the topic for the webinar is long-term growth, short-term risk. And before we actually kick off anything, I think I'm going to get everyone to kind of just do a little exercise and interact a bit. So I just want everyone to participate in this poll and think a little bit. So with the title, today's event title, I'm actually going to start a poll here. What do you think is the biggest short-term risk right now? One being Delta variant, second, inflation risk, third, China slowdown and crackdown, and fourth, Fed tapering. Okay, great. I see answers coming in. Wow. Inflation risk at 40. Wow. Okay. You have, okay, inflation risk still at the leading. Okay. Nice. All right. Okay, so I think we have it over here. I think right now, I think in most of you guys, in your mind, inflation risk is still the biggest risk over here. We had about 45%, followed by the China slowdown and crackdown, and Delta variant, and lastly by the Delta variant. Well, I think, thanks for the participation. Of course, I think, in fact, all of these risks that we have actually mentioned here are very relevant, especially in today's market. We do duly note that growth momentum appears to be slowing. Central banks' policies are starting to taper, and the Delta variant is, clouding some countries' reopening plans as well, including Singapore. And over in China as well, I think regulatory clampdowns are starting to impact growth trends. But nonetheless, I think we do believe that the global economic outlook still remain healthy and ahead of expectation for the medium and long term. So I think without further ado, let me introduce you to our speakers for this session. He is definitely the face for UOBAM and is no other than our head of multi-asset strategy, Mr. Tony Raza. He joined UOBAM in 2008 and has over 30 years of investment experience. So Tony here today will be sharing with us why investors today should stay optimistic and at the same time cautiously navigating the elevated near-term risk for the last quarter of the year, so that to be able to clear the immediate hurdles. So Tony, the stage is all yours, please. Thank you so much.
Okay, thank you, Edward. Okay, so welcome everyone again. I think many of you know we try to do these quarterly updates on what we're seeing in the macro environment to give you a sense of how we're positioning our own funds and how maybe your investments are being managed, but also just to give you our best advice for your own investment purposes as you're trying to figure out what to be doing over the coming quarters. So as Edward mentioned, we were calling this quarter one of sort of it has long-term growth and long-term constructive elements, but near-term risks, and we're trying to balance all that. So let me get into a little bit more on how we're thinking things. And so this first slide just sort of summarizes things for us. And on the broad outlook, I don't want to leave anyone with too confused a feeling. I think that broadly we should all be aware that the growth outlook for the next couple of years really looks quite robust. We're in an expansion period, and we're also in a period where interest rates on the short-term side really are going to be low for a couple more years. And this is a healthy climate for investing. And as I get into talking about the risks that are a bit of a concern to us, I don't want anyone to be clouded in that view that really this is a good time to invest, and we should over this coming quarter and the next couple quarters, we should have a bias towards trying to find ways to enter the market at good levels and at good times. But nevertheless, there are a number of issues out there, and therefore in the coming quarter, we're kind of more neutrally positioned. And I think many of us know these risks. They involve firstly, just this slowing growth momentum or this peak growth issue. The pandemic still has to be managed, and we're in this process of reopenings, but it's not exactly clear how everything will go. We have valuations that are challenging, we have China risks that we're dealing with, inflation risks, and so on. So I guess within this, I think I'm going to summarize how we see the positives on the growth, and just to be clear what you should be looking for. But then, as we look at these risks, I'm largely going to be presenting that on each one of them, our base case is fairly benign. We don't really think the pandemic is going to stop the reopenings. We don't think China is going to create a systemic problem for Asia and the rest of the world. We don't think that the tightening of policy is going to stop the performance of markets. But I think if there's the way we would summarize it is, as we're dealing with things right now, the list of risk issues is a bit long, and when it's this long, it's easier for one of them not to go according to our base case, and there's one of these to sort of surprise us to the downside. So in periods like this, we do end up being a little more cautious, but I'm going to describe how we've raised cash, but this is with a bias towards finding the right opportunities over the coming quarter. And I think that's the message ultimately that I want to leave you all with today. So let me get more into the details of how we think about this. So firstly, as we provide these updates every quarter, you can go onto our website, you can find our quarterly positioning, and you can find charts like this that sort of lay out, asset class and regionally how we're positioning all our funds. And so the broad message here I would have is that, we sort of neutralized equities with fixed income. As I mentioned, our broad bias is actually to be leaning into growth assets when we're in an expansion like now. But in the fourth quarter, we see enough risk that we just kind of want to play it more neutrally. And if there's a line I would point out at the bottom, we've raised cash levels in most of our funds, and we're kind of aware that there's a risk of sort of, modest corrections, and we would have a bias to wanting to buy into those and have a little bit of cash to do so. But in the meantime, things like that we've been previously overweight earlier in the year, like equities and high yield and commodities, we're kind of all just a bit more neutral on them right now. And then on this next slide, we even have, more detailed breakdowns, region by region, specifically within duration and currencies, how we're positioning everything. You can find this on our website, but I would just leave the broad message right now. I think if you look through most of this, we're not taking big bets this quarter. We're kind of like hunkering down to make sure we survive this quarter and finding entry points for those growth assets. Okay, so let me talk about just what the base case for a continued expansion looks like and how that should be kind of most fundamentally how you should be thinking things over the next several quarters as sort of like your bias and how you should be investing. And so, we would use a chart like this and say, really, you don't have to make things too complicated. The growth outlook over the next couple of years is healthy. If you look at this top line of a table like this, which is global GDP, I would frequently highlight that if you have anything over about 3.5% on global GDP, then you're above trend and you have healthy growth in the world. Back in 2017 and 2018, we were above 3.5 and markets generally were doing well. And right now it's even better, right? So for 2021, because we had that recession in 2020, the growth levels are very high in 2021. 6% global GDP growth is expected for 2021, and 4.5% is expected in 2022. And so just really broadly, there's a lot of confidence that there's growth that companies around the world are going to be able to participate in, and asset classes will benefit from. And specifically then when we get to companies, while GDP around the world is good, actually it pales in comparison to what's going on at a corporate level. Earnings growth around the world has been stunningly resilient. Corporations around the world have managed this crisis very well. And in 2021, we're getting like over 30% earnings growth in most of the major regions. And really month by month as this goes along, we, as high as these growth targets are, actually every month we see positive revisions. So these things keep getting revised up. We don't really see any weakness where these numbers are looking too high and analysts have gotten ahead of themselves. On this next page, we have, we keep track of what are the revisions for all the major regions. And do we see any weakness, like analysts realizing that as the results coming out that they need to downgrade their forecast, but they're not doing that. Month by month, they keep revising up their forecasts at a fairly healthy clip. And so again, this is the healthy backdrop to investing we all like to see. And therefore, as I mentioned, the risks, I don't want to give a mixed message. This is a good time to be investing. And then I guess, big picture, we use a cycle thinking like this into the sort of background of how we think about investing throughout a cycle. And this is an investment clock. I've shown it before. Many of you maybe have seen this in a finance textbook. But the way we think about it is, as you go through an economic cycle, within this clock, the top of the boom is at 12 o'clock, and the bottom of the bust is at 6 o'clock on the clock here. And so we would argue that with the recession that we had in 2020, that brings us to the bottom of the economic cycle. And then we start going through an expansion phase. And then listed here are typically the way asset classes will usually perform. Sometimes the timing may be different, but generally as you go through an expansion, you start to see equities performing very well in the expansion. As you get further into the expansion, prices of things start to go up. Things like property prices go up, commodity prices go up, inflation goes up, and you keep expanding until you get to 12 o'clock on this cycle. And I think already we're seeing a lot of this. Usually it might take longer before these price pressures really start to build. But already in the initial stages of this recovery, we're seeing a lot of this kick in. And really our bias is until we get to the end of this cycle, we should be focusing on these growth assets. And that's things like equities, property, commodities, and then even within fixed income, it'd be things like credit that's going to benefit from healthy corporates. And so, that's where we should be on the lookout. And then I guess a critical question we always think about as we use a clock like this is, how long is this going to last? How long is it going to take before we get to the end of this cycle and we're going to be in this expansion phase? And so, one of the main things we would take away is, if we look at how long cycles usually last, in the last 50 years, cycles have usually lasted between 6 to 10 years. And we're only a little over a year into this expansion. And so not only our current forecasts are for healthy growth in the next couple of years, there's a lot of reasons to believe that cycles should last longer than just a couple of years. And that gives us confidence that we're probably going to be in this expansion phase for several years at least. And that makes it a pretty good time to invest. And I think from here, I'm going to start talking about the risk. But again, I guess the message was, don't let my concerns about the risk overly confuse you. Behind it all, this is as sort of straightforward as it gets. We should be looking to find ways to get invested. Actually, the other part of it is that we are in a period where interest rates are very low, and although in the next few years those interest rates will eventually start to climb, even that's going to take a while before you get to higher levels of interest rates. And this combination of good growth and low rates really is sort of a no-brainer when it comes to investing. There are not many periods in history where this has added up to be a bad environment. This is the type of backdrop that provides good backdrops for investments. And then one more aspect that I think stands out in this cycle is that the fund flows of the way people are investing around the world is more sort of a clear pattern of what we would usually see historically, but we didn't really see in the last cycle. And I would argue what we're seeing now is a more healthy way of investing than we've seen in a while. So specifically what I'm referring to is just the fund flows into growth assets is more clear and coming through more convincingly than we've seen in really about 10 years. And so this is just some of the data that we track. Maybe just to the way I would summarize these charts is on the graph on the left-hand side. Look at those blue dots, and those would be the year-to-date fund flows into these various asset classes. And as you can see, all these blue dots, they're positive. Everything's getting positive fund flows. And on the right-hand chart kind of just adds up the total as we go through the year of these positive flows. And I think, again, what stands out is equities, bonds, commodities are all getting very healthy fund flows. The only thing that's kind of negative is money markets and cash. So people are taking their cash and deploying it, and that's contributing to the buoyant markets that we've been getting. And I guess just to be clear, this yellow line that's going up in equities, that's not actually what we were seeing in the last cycle. Throughout the last cycle, equities performed and continued to make new highs, but it was kind of like grudgingly doing so without a lot of inflows into equities over the last cycle. This cycle is looking more traditionally positive. Okay, so that's the positive backdrop. And in many ways, I'm going to feel guilty now as I maybe scare you of all of our concerns. But let me go through some of them because they are the issues that are pressing for the day, and part of the reasons why even over the last couple of weeks we start to see some volatility in some of the growth assets like equities. So the first issue I would say is that we're getting a lot of signals that this positive growth levels that I talked about, that the momentum on that is slowing, and that we're getting a lot of signals in markets that aren't the healthiest of signals. So let me try to explain this. So firstly, I mentioned GDP growth for the world in 2021 and 2022 are expected to be really healthy growth levels. But a chart like this is showing as data is coming out, is this even better than expected or worse than expected? And what we've been going through all year is that This blue line, when it's above zero, that means data is better than expected. And through the past year, um, the economic data that we were getting was even better than everyone was thinking. And that caused everyone to keep revising up their forecasts. What's happening right now, though, in the last month or so, we're starting to get data that's coming in a little bit below expectations. And now economists are starting to realize, well, what we were expecting, it's still a good number, but it's maybe going to be a little bit less than I thought last month. And so you're starting to see it in various ways. So in a chart like this is put out by the Fed. This is put out by the Atlanta Fed, and it shows that with the economic data releases now, what would GDP just be based on everything we've just seen so far? And that's what they calculate as a GDP now. And you can see this green line is GDP now. And as we've been getting data, it kind of been implying that the third quarter of 2021 is actually turning out weaker than it was initially looking. And this blue line is the consensus of economists. And you can see that this blue line is getting pulled down by the more we get disappointing data, the forecasts are being brought down a bit. And another way of looking at this is, we just keep tracking this on a regular basis, but this is the consensus for forecasts for various economies around the world. And in particular, this is for the US economy. And what you're seeing now is throughout the year, economists just kept getting impressed with everything they were seeing, and they kept revising up their forecast to a very high level of 6.5%. But in the last month, things have started to change. So they started to revise it down to 6.2, and I think the latest number is even a touch below 6. And the thing is, this becomes confusing to digest. Not to make things too complicated, 6% is still great growth, but we're dealing with this issue that it's not quite what we were expecting a month ago, and therefore asset markets need to sort of adjust and they become a little bit volatile and wobbly in periods like this. It's not meant to be that this is bad. That growth is weak, overly weak, but it's an issue. So that's slowing growth momentum has in markets. And then you're starting to see the impact of that in various asset classes. So firstly, one of the things we're always checking, we have it in various models that we use to analyze if a recession is coming and so forth. But what we look at is global credit spreads. And we track what are your weaker credits, like high yield credits, doing versus your strong AAA investment grade spreads. And when you start to see the weaker company spreads going up, even though everyone's still pretty confident about the A-rated companies, this is a sign that we're a little bit less confident on the economy. You're starting to see high yield go up, even if investment grade's okay. And actually, this movement is pretty small, and I don't really have it as a big warning, but it's a little bit of a warning. And then additionally, this is for global. On this next chart, we track how the spreads are performing in Asia. And the issue, I think many of us here in Asia have been aware that credit spreads have been under pressure, especially high yield spreads, largely due to issues in China, largely around property and the Evergrande situation in particular. It's creating a lot of jitteriness in the markets, but also concerns that other property companies are going to face pressures, and maybe even some of the banks. You're seeing these high yield spreads go up, and even investment grade spreads have been going up a little bit as well. So main takeaway is, as I mentioned, we're tracking growth. It's starting to be a little bit less than expected, and we're seeing asset classes start to behave in ways that they're getting a little worried. And then other asset classes that we track, we would highlight that things like government treasury yields are usually a sign of the amount of risk taking that investors around the world are doing. And we would highlight specifically in this period of maybe May to August, 10-year yields were generally softening month by month. And that is not a sign of confidence. That, as you can see, over the prior year, they kept increasing as investors got more confident about the world. And to us, this was largely about the Delta variant. The timing did kick in when the Delta variant really started to take off. A lot of people were buying treasuries as a safe haven asset. In recent weeks, treasuries have started to go back up. And in many ways, that's, I think, a little bit of a sign that markets are getting more comfortable that the world's getting through the Delta variant. But it's also a sign that other risks like inflation are growing. And then finally, also, the dollar was rising over this period. And to us, that's just a sign that markets are seeing risk issues. When the US dollar is strengthening, that's a risk off signal. That's people getting to safer assets. And then I guess one final one just on this period to summarize what we're seeing is, through middle of September, all the way from the beginning of the year to the middle of September, the global equity indices continue to make new highs, right? And so in many ways, looking at stocks, you would have said, it doesn't look like markets are that concerned about some of these risks. But we were highlighting that if you looked at internally at the way stocks were behaving, the internal dynamics were showing some concerns. And specifically, in this period from like May to the end of August, what we were seeing is that the type of stocks that were doing well were things like the work from home stocks, and the things that were performing not so well were the reopening stocks and the reflation trade stocks. And so markets continue to make new highs, but the internals of it weren't particularly healthy in the last few months. And so I think a big part of all that was the pandemic risk. And I think as we've been talking for the last, I think if you tuned in and listened to us last quarter, we've had a base case that has remained constructive. But as the Delta variant kicked in, we did have to admit that this is adding uncertainties, and it's a little bit harder to forecast with certainty what's going on. And although our base case was we thought the world was going to continue to reopen, it wasn't. There were at least uncertainties growing. But as we stand here today, I would say I think it does boil down to this, and everyone tracks COVID, so I don't want to bore you all with things that you talk about amongst yourselves every day. But I do want to highlight that I think when it comes to how markets are interpreting things, it's really boils down to our economy is going to be able to reopen or not, and all our analysis of COVID in so many ways. There's so many things to look at, but when it comes to markets, it's just really about the reopening. And so I think the way I think markets have concluded things over the last few months is, one, I think markets have realized, any type of, pure herd immunity that really sort of made COVID go away. I think that's largely disappeared with the Delta variant. I think many epidemiologists actually thought the vaccines were effective enough. You could actually eliminate COVID, like polio was eliminated, like smallpox was eliminated, that was on the table as a possibility. But with the Delta variant, that sort of got eliminated as an opportunity. So the world has to realize this is going to have to be managed in an endemic manner. And then the other issue that I think the markets are tracking, and I would highlight that I still think not everyone is completely aware of, is vaccine production in 2020 in this year, 2021, is enormous. I think many of us have been discouraged, particularly us in Asia. We've seen the Americans and Europeans get themselves vaccinated, but it wasn't getting out to everyone. And Asia's starting to get it, but there's still Africa and other emerging markets. And so I think there's a discouraging feeling that it's going to take a long time to vaccinate everyone. But I'll show you the numbers on the production. And the reality is there's something like 13 to 15 billion doses being created in 2021. That can go a long way to vaccinating everyone. And so production isn't the problem. It's kind of just that last mile of getting into everyone's arms. And then I think then the other issue for markets, the same as what we're all talking about, but the variants are the key risk, and Delta variant might be enough to derail some of the reopening plans. But I think it's actually just becoming clearer to markets in the last couple of weeks that actually our base case of a reopening plan should be intact. It's still unclear how everyone's going to react, but I would admit even my personal confidence, if you had asked me just even a few weeks ago, I wasn't so sure that governments were going to stay on track with reopening plans. But if you ask me today, I think I'm more convinced that they will. So let's go through just a couple of charts on this. You've probably seen stuff like this, but I think investors around the world, the first thing they do is they've been tracking the first countries to get vaccinated. So how are they doing in the face of COVID? And there's sort of a mixed answer. The first part of the answer is, well, the cases in places like the UK and the US are just as high as in the peak of the storm at the end of last year, beginning of this year. So that was a discouraging result. And that's when markets started to get more wobbly. That's when the 10-year yield started to fall because, hey, this doesn't look like the vaccines are working. But I think we were all aware that the ultimate test is, well, does it prevent deaths? Does it prevent hospitalizations? And the data was, yeah, it looks like it's doing it, right? And so in these leading vaccine countries, the fact is Germany and the UK had higher vaccination rates than the US. And even though the UK had just as many cases as during this period, their deaths were not anywhere near what they were seeing before. And they're starting to go down now. They're starting to go down in the US. And I think this is leading to confidence that, yeah, we can start to shift to an endemic management. It's certainly not a conclusion that we all know for certain, but I think markets are increasingly confident that's where we're getting to. And we'll have to see how the winter months go, and we'll have to see if there are other variants. But I think you're starting to see it in pricing a fair degree that there's growing confidence in this area. And then us based here in Asia, this chart has maybe too many squiggly lines to follow, but I think what we're all aware of is in the prior rounds, Asia was a leader in managing this pandemic. When the Delta variant hit, Asia was getting hit just as hard as what the Western countries were doing. And even Singapore, I find it kind of stunning to see that we're a leader now in terms of number of cases on a per capita basis compared to the UK and compared to the US. But when it comes to hospitalizations and fatalities, it does look like it's being managed, and that's the ultimate question. Can we live with this without hospitals getting overwhelmed? And my interpretation of what markets are saying is markets think yes. But it's if there's any of you who doubt it, that's fair enough. There's certainly markets can get surprised by a turn of events in the coming months as well. And then the other part that I've been highlighting that when I speak to many investors, I think there's a certain amount of pessimism about how quickly vaccines can get out to the rest of the world. And, you know, I show charts like this just to say it's true that Asia, many countries in Asia are still below places like the US and Europe, but it's changing very quickly. These numbers are going up by like 10 to 20% every month. And quite honestly, there's many countries in Asia that have already passed places like the US and the UK. So Singapore, South Korea, Malaysia, Japan, they're already ahead of the Western countries. And those that are lagging, I really think it's a matter of months, and you'll catch up with places like the US. And not that the US is the greatest bar to be clearing. The US is among the countries that are dealing with the most vaccine hesitancy. But at least that differential between Asia and the West will start to go away. And then obviously there are other parts of the world that the vaccines will need to get out to. But I kind of remain optimistic that these things happen faster than I think people realize. Okay, so, I'm sorry, a couple final charts. Just, I think everyone's been tracking just this data on, are the vaccines working in terms of preventing sickness, preventing deaths. And, you know, this is just one study that I know we were reading. There's many more that's kind of just telling the same story. But in a chart like this, it's maybe too much to get into right now, but this dashed line in the middle here that's been rising rapidly, that's the cases per capita of the unvaccinated, and this solid blue line at the bottom is the cases per capita of the fully vaccinated. And so charts like this do sort of give reassurance, despite the fact that there's lots of people getting it. The vaccines do look like they're doing what they're supposed to, and this is on a catching COVID. On this next chart, this is on hospitalizations. And so even more importantly, this straight line here at the bottom, this is the type of studies that we're getting at when it comes to preventing hospitalizations. The hospitalization cases really are coming among the unvaccinated, and that the vaccine's efficacy, which is this dotted line at the top, still looks like it's holding up in the face of COVID, in the face of the Delta variant. And then finally, a chart like this is, we have detailed reports on exactly all the pharmaceutical providers and what their targets are for vaccine production. And then we have their commitments to all the countries, and they're largely making their commitments. Nobody's really missing these commitments. And all our point, it would just simply be the numbers here are too many and too small. But if you just focus on this bottom right-hand corner, this is the amount of production for 2021, and it's over 13 billion. And this doesn't even include the COVAX numbers, which are additional commitments. So the production is enormous, and we should have some reassurance by all that. Okay, so I've talked enough about COVID, and we all talk about it amongst our friends every day, so I shouldn't over-belabor it, but obviously still a big part for markets. The next section I wanted to get into was what I think is increasingly becoming probably the most important issue for markets is the unwinding of the very supportive policy that we've had over the last year. So I think there's a number of areas that it's being affected. It first started with China. China is what we'd have called, a policy tightening on multiple levels, from monetary policy, fiscal policy, and lots of regulatory policy. And that's definitely slowing things down in China. We're seeing money supply growth, which has been so strong and supportive over the last year, is starting to slow down in all the major regions. We're obviously now dealing with the Fed's first step in unwinding policy, which would be the tapering of some of the bond purchase programs that they've had. And at the same time, we're getting fiscal policy drags, which really is nothing more than we've had tremendous fiscal policy last year, and we're doing much less this year. And on an economic terms, that creates a slowdown in your economic numbers. So I guess that these are all many topics here, and there's various issues that we think are going to be affecting markets. But how about let me just hit a few of them, and I guess leave you with some of our thoughts. So the first one then is, monetary policy has been very supportive over the last year, and on several fronts. I mean, right now, I think the market's all talking about how will the Fed go about tapering their bond purchases. But I'd say it all adds up to the same thing, that the amount of positive support we had last year is fading, right? And so I think nothing more than just looking at M2 growth around the world, whether you're looking at Europe or the US or China or even Japan is similar, that all these numbers are rolling over and you're getting much less accommodative policy. And additionally, I would say that you can kind of see the way the policies are affecting markets. And so, for example, this chart here, it's this orange line is the 2-year yield, and the purple line is the 30-year yield. And the way we would highlight this is that, your long-term yields are really kind of driven more by long-term structural growth views. And the orange line is driven more by your near-term issues on what you think the Fed's going to do next year. And so so usually these yields tend to go broadly together, but what we're getting is this sort of divergence where near-term yields are rising rapidly, and long-term yields actually, as of this chart, they were still declining. Actually, in recent weeks now, they started to long-term yields are going up, but you're getting this spread where short-term is going up a lot and the long-term yields not so much. And so what this is saying is that this is a signal that the market is expecting the central banks around the world to start tightening. And so anyway, like we showed on the M2 growth numbers, you're seeing it in these bond yields, the way they're behaving. It's markets are feeling that central bank tightening is coming. And then I guess another way of saying just that same thing is this is essentially the yield curve. The higher this number is, the steeper the yield curve. As it's going back down, this is a flattening of the yield curve. And that flattening of the yield curve does happen when markets are a little bit less bullish and a little bit preparing for central bank tightening. Okay, so and actually, as a final point on just sort of global policy tightening, policy tightening can create jitteriness in markets, hence part of our caution for the fourth quarter. But not to be confused with, this doesn't mean markets have to be bad. So for example, all I did here is just show global equities. So for example, if you look at this white line, this is global equities over the last decade. And tapering talks started in 2013, but you saw global equities continued to make new highs throughout that. And then the US Fed didn't start hiking interest rates really until 2016. And then they hiked it every quarter throughout 2017, but that didn't really stop global equities from making new highs. It wasn't until you sort of got to more 2018 where the interest rate hikes did start to weigh on markets. So if there's a message, it's not, so we do think that there's a lot of signals that policy is not as supportive as last year. That does not make us automatically bearish. That just makes us cautious that markets are going to have to deal with this, and there are frequently periods of volatility and some near-term corrections, even though, as we said from the start, our expectation that markets will be making new highs over the next couple of years, and it's just a matter of finding the right entry points. So actually, the last part of the tightening that we want to talk about was China, and this is a long topic, and I think I'm already close to getting towards the end of our time and all, but I think we're all feeling it a lot. So let me summarize what we're seeing on China and our views. And you know, at UOB Asset Management, we published a white paper on what we think about all these policy moves in China. And I would say if there's a simple takeaway from all that is we break down the various regulatory changes that are going on and the reasons that we think are behind it all. But in the end, our view is that on a medium to long-term basis, this is not necessarily negative for China. This is probably going to be even a net positive in the long term. But in the near term, there's a lot of volatility created, and we're going to have to manage this as fund managers and be very careful around this. So let me show you just a couple of charts. So one, this is just industrial production over the last couple of years. And I'd say that, you know, at the start of 2021, I think China felt pretty clearly that they had managed the pandemic well. There was a pretty big gap emerging between how well China was doing versus the rest of the world. And I think China took this as their chance to deal with some of the structural issues that have been a bit of an overhang in the China market. And I do think, you know, the confrontations between the US and China in the last several years have created a greater urgency that China wants to make sure their house is in order for whatever may be coming in coming years, that they want to be on solid footing. And hence they're addressing many issues from the sustainability of their growth to the sustainability of the political balance, and therefore addressing inequalities. They're addressing sort of some of the antitrust issues that go on with some of the tech companies, and some of the excess credit that has gone on, and particularly the property sectors, the unfairness, some of the profits taken out of education, and so on. We all know all these measures that China are taking care of. At the heart, we think they just want to address structural problems and make sure their ship is in order. That's not a bad thing, but it is creating chaos. And so, and in particular, what it's creating is that China growth is rolling over now. We're getting a lot of signs of that all these measures are weighing down at a time when the other countries have started to get stronger. And I guess I just summarized all these points, but you know, we're seeing it in many levels, from the antitrust on big tech platforms, the fairness in education, deleveraging of property, more aggressive environmental policies that are affecting some of the energy prices and so forth. So there's a lot of ripple effects. And I'd say in the end, I think our takeaway is that this does remind us of periods in the past when China has tried to moderate debt and so forth. They did result in weaker years of growth, such as like in 2015, and those weren't particularly strong years for China equities or Asian equities. Our bias is actually, we think there's an outstanding buy call to be made in Asia. We think Asia has an attractive set of years ahead of it, but we're not really going to pull the trigger on that until we see some of the headwinds from these regulatory issues start to stabilize. I think just as a takeaway here, so if in a chart like this, you can just simply see that this green line is global equities over the past year. You can see up until recent weeks, global equities were making new highs, and this was a great year for global equity investment. The blue line here at the bottom is China equities, and clearly, once they started these regulatory policies, it has weighed on markets, and China equities haven't been doing particularly well, and that also affects Asia. Asia has a hard time performing if China is not performing. So I think I think we could go on for a while about the messages in China, but if the main takeaway is we think the news flow, the issues, at UOB Asset Management, our credit fund managers in our morning calls are really addressing what they're seeing on a daily basis. They're highlighting to everyone the fact that this is a lot to manage, and it's a challenging environment. I myself, as more of a big picture macro investor, I see the specific risks that the fund managers are dealing with, but I'm more willing to sort of look beyond it on a one-year basis and say, oh, I think there's going to be a buying opportunity at some point. But my advice is, I think it's too soon to call it. There's just too many uncertainties yet. Technically, we've seen a couple of bounces along the way. In August, I started to wonder, did China already find its bottom? But in September, it found a new bottom, and it's bouncing off that. But still, our message is it's probably still too soon to really call an aggressive call on Asia. All right, so I think those were most of the slides I wanted to go through. I have some of the detailed models we use, but I really save that only if people ask. So I want to stop there. I want to invite Edward to come back in and help coordinate questions that you all might have, and see if there's anything else we can address. As a sort of final message, I think I said it from the beginning, we're constructive on a medium to long-term basis, but these issues, there are enough issues that we do advise some near-term cautious in trying to find the correct entry points. So anyway, I hope that's clear enough. I'll stop there. And Edward, can I ask you back to coordinate?
Yeah, I think thanks, Tony, for the insightful presentation. I hope everyone had some key takeaways to take from that. Okay, so let's look at the Q&A, and I think we have quite a number of questions over here. I think let's just go with one. Is I think one of the questions that the S&P 500 earnings are expecting to hit a new all-time high in 2021, contributed by stellar profits in healthcare and tech sectors. So I think the question mainly is, will this trend continue? And if yes, why? If no, why as well? So yeah, Tony, please.
Okay, yeah. So I do think that's kind of one of the hidden stories that have gone over last year, is the ability of corporates to be dynamic, manage this really difficult period, and to produce really healthy profits. And obviously, it's led by some sectors that have benefited, but even those that are put in a bad position, they manage the downside very well. And what you have is the overall market profitability at very high levels. And I recall in the midst of 2020. Talking to investors, fellow fund managers, and we would speculate how long would it take for global earnings to get back to pre-crisis levels, and people would say 2023, but here it is, by the second quarter of 2021, quarterly profitability was already back to pre-crisis levels. And so then I think the other part of your question is, can it be sustained? For the most part, I do think there are interesting things going on in the world. the sort of all the stimulus measures have created enough sort of a Keynesian impulse that it does seem like there's more economic growth, more profitability growth than we've seen in the rather lackluster years we had in the prior decade. It kind of reminds me of sort of prior cycles and healthier cycles of the past. So I do think there's a basis of not only the efficiency of what companies been doing, but just sort of a more reflated environment tends to bode well for profitability. And therefore, our base case is to lean that I think there's a good chance that the coming years remain healthy for companies.
Okay, thank you. Then I think we still have some questions. I think from Rebecca as well, and I know she's asking, what indicators will you look out for a call to call a bottom in China? Sorry.
Okay, yeah, that's a big question, and on our teams we've been debating, struggling with it. But I think it boils down to a couple things. So one, how confident are we that China's getting more comfortable with addressing their structural issues? Because obviously, if there's still more to go and there's another year of it, then I think whatever the economic indicators are, we're probably going to maintain a little bit of bias. But if, for example, I'd say there's this combination we're probably looking for. It's one that, at least in terms of new measures, seem to be slowing down, and it looks like they kind of realize a need to not be so harsh and maybe lower interest rates to some degree. And we're kind of seeing some of these signs. And that we start to see a stabilization in sort of what I would call the leading economic indicators, which would be things like these are the PMI, manufacturing indices, and so forth. And so as I read them now, I think it's still too early that the signals we're getting aren't clear enough. But anyway, it would be that combination that the policy direction seems to at least stopped being aggressively addressing things, and the leading indicators start to tick.
Okay, I think the follow-up questions, I think also specific to this region over here, is that could you actually kindly comment on the Asian high yield market, particularly its behavior since the start of October? Yeah.
Okay, yeah. So Asian high yield spreads have widened very considerably. I think I showed it in a previous chart, but to describe it simply, they have risen to levels that you would say this is a market that's under a lot of stress. It's higher than anything we've seen up compared. You have to go back to the heart of the pandemic crisis in March 2020 to compare the numbers we're getting now. And just to throw out there, credit spreads in high yield are over 8%, and that's a sign of a market that has a lot of concerns. Specifically, we do think it's fair to say that property is under a lot of pressure. There's a lot of the amount of credit expansion is very tight, and there's a lot of evidence that developers do not have access to the liquidity that they need, either from the private markets or from even banks lending. And so that creates a lot of jitteriness, because companies can fail in one of two ways. They could be have a true credit problem and they don't have the ability to pay their debts, or they could face a liquidity issue. And even though their business is okay, they just can't get the funds. And so what we're facing right now is a little bit of both. That companies like Evergrande have shown that they're not as solvent as some had hoped, and now it's sort of spilling over into other property companies. I'd say as a sort of final takeaway, it is our house view that in the end, China has the resources to stabilize things. I think the obvious concern is, can this become more of a systemic problem that ripples through property in the banking system and hurt the whole economy? And we would be pretty confident that that's not likely what we're going to face, that before China would let it become a systemic problem, they do have the resources to address it. But their goal here is to deleverage the amount of excess leverage in property, and therefore this pain that we're going through probably doesn't go away right away. And I'd suspect at least another quarter of dealing with these types of issues.
Okay, Ken, thanks. I think apart from that, I think on the China side, there's also this, the energy crisis as well. So I think one of the next question would be that, what is your take on the global energy crisis and the supply chain disruption? Yeah.
Okay, yeah. And I would admit, I've been racking my brain trying to get my mind around what is going on. I personally have always kind of had a lot of confidence after the last cycle that every time energy prices got high, supply would come in fairly rapid order, and that kind of capped the level of like oil prices or energy prices in general to sort of moderate levels. And after getting to over $100 a barrel of oil back in the prior cycle, in the last 10 years, we never really got that much above 80, and that's because supply would always keep coming. And I was kind of suspicious. Well, once oil prices got up there, or energy prices in general, supply will come. But what I find confusing is that the stories going on around the world are sort of just different stories for different regions. What's going on in Europe is different than what's going on in the US, and it's different what's going on in China. And so I don't really know what to make of this. Is this sort of a more profound thing that all adds up to the same issue in the end? Or is this just a bunch of individual issues that's all happening at the same time, making it seem like there's a global energy crisis? So I don't necessarily have strong views. I would say that ultimately, I would still have a bias to thinking that these issues can be addressed, that supply, that there's usually enough resourcefulness to deal with supply issues once they emerge. But I think it's a fair thing that many who are highlighting it as a real risk issue, there's a certain amount of uncertainty that's around it that I think is fair that's to acknowledge. And I guess ultimately it is things like that, because I can't get too confident on these trends. I turn a little bit more cautious for the fourth quarter.
I see. Okay. I think the next question probably would be that, what are the specific, growth assets that you think investors should look out now before the investment clock strikes 12? I think your investment clock, I think that's a very interesting question.
Okay, yeah. And I would say, so the clock would just speak to the usual sectors. So it would be, equities, usually would be sort of global equities first, and then sort of more markets like Asia that tend to benefit later into the cycle. Then also things like property should do well this cycle, commodities should do well. So those are all the usual suspects. I suppose with a little bit more granularity, I would highlight that the way we see certain types of companies performing, as I think, we kind of have what we call a structural bias towards some of these exciting trends, these sort of mega trends that are going on in the world. And that would include things like the trends in technology. We still like to participate them and think it's a multi-year thing that's going on. We still like a lot of what's happening in terms of especially demographics, and Asian demographics is an exciting trend that I think there are ways to participate into in Asia. And on sustainability, we think this is just a big thing that's sort of readjusting the way businesses are run, and there's a lot of opportunities investing around these fronts as well. So on a multi-year basis, that's kind of the things we keep getting back to.
Okay, thanks for the answer. I think, time is actually running, and let's just answer one more question. I think this question is suited very well to the theme of this webinar today. I think the question is, what is a good short-term defensive position or strategy to adopt for this current volatile market environment? Yeah.
Okay, yeah, and it's a good question, and the fact is it's kind of unusually tricky compared to other periods. So the reason is usually if I'm getting more defensive, what I usually buy are things like government bonds. And the reality is, because the types of risks we're dealing with are kind of diverse. It's a combination of maybe growth is going to slow, and maybe the Delta variant is going to disrupt reopening and growth is going to be slower than expected. And on the other side, it's, well, inflation might be taking off. And so that makes it a little bit uncertain what assets are going to do well in this period. And so the answer is we are doing things like just holding a little bit more cash than we usually do. And yet, like, as I talked about the cycle clock, on a sort of 6-month, 1-year basis, we're not in the stage of the cycle where you want to be holding a lot of cash. You want to be deploying it. But for this quarter, we've raised a little bit of cash, and we're trying to find the right entry point. We're trying to find a dip to deploy it into. So I think that's the main answer I have for now. And it's a little bit more tricky than other periods.
Yes, I believe so. Yeah, so I think with that, just nice. We are at 1 p.m. sharp, and with that, we have actually come to the end of our investment outlook. I think the key takeaway is that we should stay optimistic as the current macro environment is still in the midst of a healthy expansion, and hopefully today I hope that we are able to actually provide everyone here with a better understanding of the various short-term risks, so that you are able to tread this current volatile market strategically. So I thank everyone, and I thank Tony, and have a great week ahead. Thank you so much, everyone. Have a nice day. Bye-bye.
Thanks, everyone.